Imagine you have £10,000 ready to invest. It's a significant sum, enough to make a real difference, but also enough to make you pause and think carefully about where to put it. You want your money to work for you, to grow, and maybe even to open up new opportunities in the future. But with so many choices out there, where do you start? The buzz right now. Rolls-Royce, the engineering powerhouse behind jet engines and nuclear submarines, not the luxury cars. This is a company with a legacy of innovation and a reputation for powering some of the world's most advanced machines. As of January 9, 2026, everyone's asking, is now the time to buy into this British icon? The headlines are everywhere, and investors are buzzing with excitement and curiosity. The stock market is unpredictable, and understanding a company's past performance is key to judging its future potential. History doesn't repeat itself exactly, but it often rhymes, and smart investors pay close attention to the patterns. Investing is about backing a business you believe in, hoping your money grows as the company succeeds. It's a leap of faith, but also a calculated risk, one that can pay off handsomely if you choose wisely. Rolls-Royce's recent story is nothing short of a blockbuster. After years of challenges, the company has staged a dramatic comeback, capturing the attention of investors worldwide. If you'd invested $10,000 just a week ago, you'd already be up to $10,150, a quick, impressive return that's hard to ignore. It's the kind of gain that makes headlines and gets people talking, but with big gains come big risks. The market can turn just as quickly, and what goes up fast can sometimes come down even faster. It's a thrilling ride, but not for the faint of heart. This guide will break down what's driving Rolls-Royce's surge, tracing its journey from the pandemic lows, when the future looked uncertain, to today's remarkable highs. We'll explore the turning points and the factors behind this dramatic shift. We'll look at its business segments, compare it to rivals, and highlight the risks and rewards that come with investing in a company like Rolls-Royce. You'll get a clear picture of what sets it apart and what challenges it still faces. Our goal: to give you the context and insight you need to decide if Rolls-Royce is a smart addition to your portfolio or a ride too wild for your taste. Let's dive in and see what your $10,000 could really do. To understand today's excitement around Rolls-Royce shares, let's rewind the clock and revisit a period of extraordinary uncertainty and upheaval. During the COVID-19 pandemic, global travel came to a sudden halt. Airports were deserted, planes sat idle, and the world's skies grew eerily quiet. For Rolls-Royce, whose income is closely tied to the number of hours its engines spend in the air, this was a devastating blow. Revenue streams dried up almost overnight. The share price plummeted to historic lows, and for a moment, the company's very survival was in serious doubt. Investors and analysts alike questioned whether Rolls-Royce could weather the storm. But as the world gradually reopened and travel restrictions eased, the skies filled once more. Rolls-Royce began to recover, staging a dramatic and unexpected comeback that few could have predicted at the pandemic's darkest point. If you'd invested $10,000 at the pandemic's lowest point, you'd now be sitting on over $300,000, a staggering 3,000% gain. This kind of return is almost unheard of in such a short time frame, and it captured the imagination of investors everywhere. The recovery didn't stop there. Rolls-Royce's momentum continued to build, fueled by renewed confidence and a surge in demand for air travel. In 2023, shares soared an incredible 221%. In 2024, they climbed another 90%. And in 2025, the rally continued with a further 95% gain. Each year brought new highs and fresh optimism. This relentless growth has made Rolls-Royce a true market star, drawing in waves of new investors eager to ride the momentum and be part of the story. The turnaround is thanks to bold restructuring moves, the rebound in global travel, and the company's strategic importance in aviation, defense, and energy sectors. But remember, Rolls-Royce's fortunes are still closely tied to the health of the travel industry and the broader economy. The same reliance that once hurt the company remains a key risk. Past performance is no guarantee of future results, and investing always carries risks. That's why understanding today's situation, the company's fundamentals, and the market context is crucial before jumping in. The company's rise is remarkable, a testament to resilience and strategic change, but fortunes in the stock market can change fast. That's why context, research, and caution always matter. The latest surge in Rolls-Royce shares isn't just about recovery, it's about geopolitics. In today's interconnected world, global events can send shockwaves through financial markets in a matter of minutes, and Rolls-Royce's recent rally is a perfect example of this phenomenon. In early January, US forces captured Venezuela's president, sparking global uncertainty and a rush into defense stocks. Investors worldwide scrambled to reposition their portfolios, seeking companies that could benefit from increased military spending and heightened security concerns. Rolls-Royce, with its strong defense division and reputation for advanced engineering, was perfectly positioned to benefit from this sudden shift in sentiment. The company's expertise in military aircraft engines and defense technology made it a natural choice for investors looking for stability in uncertain times. Shares jumped 8.5% in a week, reflecting the market's confidence in Rolls-Royce's ability to capitalize on rising defense budgets and new government contracts. This wasn't due to a new product launch or a major contract win, but rather to investors seeking safety amid rising tensions. When uncertainty strikes, money often flows into sectors seen as resilient, like defense. Other global events, like US moves against Russia and renewed interest in Greenland, signal higher defense spending ahead. Governments are reassessing their priorities, and companies like Rolls-Royce stand to gain from this shift. More defense spending means more business for Rolls-Royce, as nations invest in upgrading their military capabilities and securing strategic interests. But this also means the share price is now highly sensitive to geopolitical headlines. Every new development, whether positive or negative, can trigger rapid changes in investor sentiment and market value. Positive news can send it soaring. Optimism about defense contracts or government support can drive prices even higher. On the other hand, peace talks or diplomatic breakthroughs could trigger a drop, as the perceived need for defense spending diminishes. Market psychology is powerful and unpredictable. Investors' emotions, reactions to headlines, and sudden shifts in global politics can all play a role in driving prices up or down. Investors need to be aware of these external forces. Understanding the bigger picture is crucial for making informed decisions in such a volatile environment. Rolls-Royce isn't just about planes, it's a defense powerhouse. Its defense division makes up a quarter of revenue, providing stability when civil aviation is volatile. Rolls-Royce supplies nuclear reactors for UK submarines and engines for military aircraft and vehicles, making it a key government partner. Defense contracts are long-term and government-backed, offering predictable income even in tough times. That's why geopolitical tensions have boosted the stock. As Western defense budgets rise, Rolls-Royce stands to benefit. Its defense division is a strategic asset and a major draw for investors seeking stability. The Civil Aerospace division is Rolls-Royce's largest and most famous arm-powering jets like the Airbus A350 and Boeing 787. Its business model is unique. Airlines pay power by the hour, so revenue grows as planes fly. The pandemic devastated this segment, but the travel rebound has fueled Rolls-Royce's financial turnaround. Surging demand for new engines and servicing has boosted cash flow and share price. The division's future looks bright, with demand for fuel-efficient engines and next-gen tech. But competition from giants like General Electric is fierce. Civil Aerospace's performance will make or break Rolls-Royce's future. Innovation and execution are key to sustaining its high valuation. Rolls-Royce is tapping into the AI boom by powering data centers with its backup generators. Its Power Systems division, under the MTU brand, provides critical backup for data centers worldwide. As AI and cloud computing expand, demand for reliable power is soaring, creating a new growth engine for Rolls-Royce. This diversification adds resilience, making the company less dependent on aviation or defense cycles. Rolls-Royce is also investing in small modular nuclear reactors, a potential game changer for clean energy. These ventures show a company innovating for the future, not just relying on its legacy. For investors, this forward-thinking approach is a major plus. How does Rolls-Royce stack up against rivals like BAE Systems and Babcock International? All three saw share price jumps after recent geopolitical events, but BAE and Babcock, more focused on defense, rose even more. Rolls-Royce offers a unique mixed exposure to defense and the civil aviation recovery. This diversification is a strength, but also means it's exposed to more risks. If air travel falters, Rolls-Royce could suffer even if defense stays strong. Meanwhile, the defense sector faces its own challenges, like political moves to restrict dividends. Comparing Rolls-Royce to its peers means weighing its balanced model against more focused competitors. It's a choice between diversification and pure-play defense. Your investment goals should guide your pick. After such a meteoric rise, is Rolls-Royce now too expensive? Its price-to-earnings ratio is above 38, a sign that a lot of future growth is already priced in. High expectations mean little room for error. Any disappointment could trigger a sharp drop. Analyst targets suggest the stock is already at fair value, so further gains may be limited. The easy money has likely been made. External risks remain. Peace could dampen defense spending, and economic shocks could hit aviation. Buying now means betting on continued flawless execution. The risks are real and the margin for error is slim. Weigh these carefully before investing. So, should you invest your $10,000 in Rolls-Royce today? The company's turnaround is extraordinary, with booming aerospace, a stable defense arm, and bold moves into new tech. But the share price is high, and the market already expects perfection. Buying now means assuming everything goes right, travel stays strong, defense spending remains high, and innovation pays off. Any slip could mean losses. If you believe in Rolls-Royce's long-term vision and can stomach the risks, it could be a worthy addition. If you're cautious, you might feel the best gains are behind us. Ultimately, understanding both the opportunities and risks puts you in the driver's seat for this investment roller coaster.